was quite amusing to be able to see the results of the poll. But it's nice to see that we've got a lot of technicians on board. So I hope that many of you really can be rendered on track with what we're going to be talking about today. Now, in our ability to be able to move forward from those, I did find it also quite curious that many of you were a little bit broad in your reasons for buying stocks. It seems that your selling seems to be much more formidable in terms of your ability to use technical analysis. But I did still see some people, at least they were clear enough to be able to admit that emotion was a problem. Some of you blamed it on prices not moving too fast, and these things tell me that since you've got such a broad range of explanations as to why, there's still quite a number of people out there have not been able to accept the fact that there really is only one enemy in trading, and it's seated in the chair that you're currently seated on. So you've got to be able to groom that person into something a bit more formidable, something where the blame game disappears, because every decision you make, every position you take, every buy and sell option you decide to be able to address and take on is really taken on by you. And given that, and since you're in the captain's chair in all of this, you have to be able to make sure that you're trained well to be able to fly this airplane to where it wants to go. And if you start pulling on the wrong gears, punching the wrong buttons, pressing the escape pod before you should, and those are the things that can come inside and ruin our plan altogether. And so the reason why we're talking about the trading plan today is because, yes, we know all the concepts, we understand what to do. We talked about trend lines, we talked about technical indicators, we looked into the markets that need to correct and consolidate. But now we have to put all those things together, and you have to be able to assess for yourselves, okay, is it time for me to enter this stock? Is it time for me to be able to push myself out? And so today we'll talk a bit about that. We'll use a lot of the things that we also learned in the last few sessions here. And I hope that you'll be able to find a bit more insights into what we're going to be looking at today, because this is really very important, because it's not just all about concept, it's all about execution. And in the right aspect of executing your trades, you have to have a plan to do that. You can't just wake up one morning and say, I feel like doing this, or you're watching the market this morning, you have no plan in mind, and you decide to go in attack mode or in defense mode. And that could change day by day. And the results of a trading plan that has no plan is just going to be an arbitrary number. Some days you make money, some days you lose, and in the end, you're playing a zero-sum game. So we're going to try to structure all of those things in our ability to look into the trading plan today. So let's get right at it. All right, so let's just quickly summarize what we talked about last time. We did talk about technical indicators, and we assessed that technical indicators are like momentum gauges that tries to be able to figure out how strong is a trend. And the job of these technical indicators is to help us to make an assessment of market condition. It gives us an alert. It can actually confirm our suspicions that a trend activity is happening or is taking place. It can also generate certain degree of predictiveness in terms of activity on price. And we use these technical indicators to lend a hand to what we're kind of looking at in terms of trends and area patterns. Remember, technical indicators should not work on their own, should not be given the top priority as against the first two. They should work to complement the system. So for example, if you're driving your car, you look at your speedometer just to get an assessment of how fast you're going. So in case you're going to have to brake, you know how much time you need. And that's what a momentum indicator does for you. Or if you look at your gasoline gauge, if you're trying to be able to travel, let's say you're trying to go another 200-300 kilometers and you're running low on gas, you quickly make an assessment of that. So you say, I'm not going to reach my endpoint, so I've got to be able to load up first. So the job of an indicator really is to give you a sense of preparation so that what you're actually going through is not just going to blindside you. And that's one of the very, very root of positive assessments of these things can give you. But one thing we have to understand is that momentum indicators do not work well in a consolidation, because in a sideways moving market, there is no momentum. And so our reliance on these indicators during sideways markets should actually go down. And hopefully we can make some assessments of that later. But the whole idea is use these indicators when you're supposed to. They work well in trending environments, up and down. But in sideways moving markets, you don't. You just pretty much use a support and resistance game. So last time we introduced the indicators called the moving average, the MACD, and the RSI. And I plotted them here on the right side so you can get a sense of what they will look like. So the moving averages are lines that follow prices. We said that these lines, just like a trend line, can act as support and resistance. So if we see that prices are breaking through them, just like this, then it can trigger on a selling condition for us. Or if it manages to bounce above it, then it creates itself like support and allow yourself the ability to buy right off that. So for example, if I'm going to be looking to buy, I can buy any of these periods. I'll probably be selling here. I will be buying back my position here, and or start selling it when it starts breaking the moving averages here. All right, then we talked about the MACD, which is a good momentum indicator, although it is lagging. But it does give you a good hand of telling you whether the buy mode of a market is still inside or whether a sell mode has come in, and that we have to be able to follow it. So just for example, in this up move and a turn down that we see here in first gen, you can see that the MACD gave us a buy signal here, and it gave us a sell trigger here, and it seems to have worked well, trying to gauge whether this upward trending market will continue and whether it started to be able to falter and fall short of it. So again, we also make use of this in terms of studying momentum. And finally, we talked about the RSI. The RSI is an overbought and oversold indicator. And we said that if the RSI indicator, which is this line here, attempts to be able to tag or surpass this upper boundary line of 70 or 80%, then we say the market is overbought. If it falls all the way back down and hits a 30% zone or lower, then it's called an oversold market. An overbought market is a market that climbed up too fast too soon and could be ripe for profit taking. An oversold market could be a market that's been falling down quite heavily, and because of the oversold condition, it could condition some other bargain hunters to come into the picture and cause the market to rally or at least go sideways. So we use these indicators to give us a much more fleshed out environment, and so we can assess the condition of the stock trends a bit better. Sometimes you would need these indicators to see more visual of that rather than trying to be able to let your mind just generate that on your own, because sometimes it might be difficult to be able to make that assessment. But with using the moving average, the MACD, and the RSI together, it should be able to give you a good gauge on how to track the market well. All right, so today we're going to talk about the trading plan. Now, when we talk about the trading plan, we really do this is because we want to instill a sense of discipline into the trader. And you might say for yourself, that's okay, I'm quite disciplined, I've been doing well, I know how to be able to do this and that. But you know, to be able to be a good or super trader, as this book over here I'm showing you attempts to come in, you have to be able to understand that if this is going to be your career, especially if you want to become a trader that's going to be the lifeblood of what you're going to be doing out there, you have to be able to involve yourself to a certain degree of involvement inside. That's something, like I said, where the discipline level is raised to the next level. Now, just let me quote Dr. Van Tharp in this one of the issues that he wrote in a book like this. A peak performance trader feels totally responsible for whatever happens and can thus learn from mistakes. These people typically have a working business plan for trading because they treat trading as a business. So the important aspect of this is if you really want to get into that level where you can get to be able to pick out any entry or exit conditions quite well, your involvement in the market has to be quite astute. Your sensitivity to the changes of a trend have to be much, much more honed up. And that involvement comes through training, through your practice. And this discipline becomes or jumps to that next level when you also try to be able to make sure you commit that all the reasons that are taking place in here is really caused by you. Yes, the environment around us can show a lot of volatility. Things can happen in the corporate side that we may not know of. Earnings is sometimes very difficult to be able to assess. Sometimes certain surprising things, or let's say natural disaster, or things like today, you can have a disease that could be quite quite interceding to what's happening and could throw a monkey wrench into everything. But understand that trading is for those people who understand how to make it work. They know what to do when something quite sudden comes. They know how to respond. They're very much prepared. And they're prepared because they've outlined all this into a trading plan. And so if something goes wrong and you can admit, I did something wrong, then it's very, very much quicker for you to be able to change that and rectify it. But if you come into this, and like I said earlier, if you generate a blame game, oh, the company did this, they did not show me that, I didn't see the earnings, my internet was poor, or whatever other reason you might come out with to be able to generate the cost for your loss, then you will never be able to rectify that problem because you've not even identified it. You keep continuously pointing at other things. So trader is a very different type of individual. He's an investor that does things through time. And he understands the importance of time. And by accepting the responsibility of that trade and to be able to launch this particular ordeals in terms of pushing the bottom to get in and pushing the bottom to get out, it's something you have to understand. You're building a business for yourself. And if you treat it like a business, you care for it like a business. It's not something you just turn off tomorrow and just say, okay, I'll trade when I want all over again. There has to be that involvement, like I say. That mastery is where it will take you to the next level. Okay, so it's very important that one of the favorite things I'd like to be able to know to tell you is that you have to understand when you create this plan for yourself and you plan this trade, once that's done, all you do is just execute the plan. And that's why it says up there, plan your trade and trade the plan. And that's a very, very important piece of information you have to be able to justify. Now, when you come inside and generate this plan, you have to make sure that you build this before you start trading, right? Because if you start building a plan while stocks are moving up and down during the trading period, then your emotions are going to get in the way. You cannot do things logically with an unbiased fashion. And so that's why these things have to be done. Never mind if it's done one night before, 2 nights before, it doesn't matter. But it's nice to see that when you come into a market condition and you have the trading affair beginning, you're all ready. You're not about to scrum, oh my God, it's still breaking out. I've never seen this. Should I measure the pattern now? Okay, so that all comes, that should be all done the night before. Now, when your mind is ready, you've done your planning, you've written down what your entry and exit prices are, then you have a mindset that's ready to be able to attack this market. Nothing that can happen there can surprise you. And it's just so easy to be able to punch the order entry button because your mind is prepared to be able to do that. Why do you, sometimes I saw you say up there earlier that it could be prices moved too fast and left you behind. Well, that's simply because a situation where people were not prepared. So the trader has to be able to take that up. I personally, if I see a stock price and it breaks out and my mind's not prepared for it, or I don't have a plan to be able to attack it, then I simply leave it alone. I'm not going to try to be able to jump into the fray and try to catch that later on, because now I'm in a point of disadvantage, not advantage. Because now I'm going to have to chase that price and I have to sacrifice my risk reward. It's something we'll talk about later. And so remember, we're here to build our trading routine. And when it becomes a routine, it's something that will come out of habit. If you're not used to be able to doing this and you just attack anything that moves day to day, then your results in the market might be quite iffy. It could be plus and minus depending on what day you are. If you're sensitive to things, then all well and fine. If you happen to be waking up with as a grouch on that day and you take that emotion with you, it's not going to work out. All right. So our trade routine should be able to flesh out in 5 points here. First, justify your entry. Obviously, we got to start somewhere and we enter the market first. So we'll try to be able to scope what we have to do to make that assessment. 2, estimate your upside targets. Okay, I want to buy this stock because it looks like it's a good potential entry. But the second question to ask is, why do you want to buy it? Is it going to go up any meaningful amount? Will I make a good amount of money here, or am I just wasting my time for 10, 20 cents on a 10 peso stock, right? We have to have good upside. 3, establish your selling conditions. Now, what that means is, once I buy this and I'm in, what do I have to do to be able to force myself out of that stock? Because there's 2 ways to come out of here. Either you're profitable or you're in a loss. And so you have to have these conditions all set. So if this stock will do this, if it goes to this price, and your mind is ready to sell. If the price goes below a certain support area and it cracks and it defeats my original plan for going there in the first place, then I also have to sell. And so we have to be able to pre-establish what these conditions will be. 4, assess your technical risk reward. Now, so you know what entry price you're going to take. You know what your upside is going to be. If you flesh out what your selling condition will be, you can now measure what your potential upside is compared to your downside, which is your sell condition. And now you can make an assessment whether is this amount of reward that I'm willing to get handled by a small amount of risk. And this is something that we have to justify ourselves. I don't want to buy a stock where I will make 1 peso only to be able to find out where I will lose 2 pesos, right? That's not good risk reward. And so I want to be able to buy something which shows me a very minimal risk for a very larger reward. And that's the kind of situation we're going to be looking for. And 5, of course, it's always good to be able to manage your risk. Understanding risk control could be a seminar in itself, and maybe one day I can put another one on that. But for now, when I say manage your risk, well, just to take it at hand first, because my objective here is to make sure that you survive your trades and that you don't, wash yourself out and completely push yourself out of this game, so that you can keep coming back and looking for a better opportunity so that you can rectify the faults and attempt to be able to make most when you make the right call. All right, let's go through each one of these. All right, now we understand that the entry point into a stock obviously is buying. Now, when you look to be able to buy a stock, you probably have your own reasons for buying it. Of course, we have a goal. We all want to buy that stock that will skyrocket, right? And so in our ability to do that, we might be able to look for quite a number of things to be able to make that assessment. We could look at the fundamentals of a company. We could also look at or listen to gossip, people telling me that something might be happening on the stock or whatever. And of course, you can also consult your technical conditions and let it tell you a particular story about what is to happen as well. Now, why do we want to rely on some of this? I think a good trader will have his ear on the ground. I don't really mean that you can just use technicals blindly only. You don't have to do that. But you can use certain things that you can hear. But I want you to be able to filter them to the technicals, because that's what it's there for. So although you may have your 3 reasons to buy, fundamentals would mean you're buying cheap, fast-growing companies. Maybe the business has a new storyline to talk about, or it could be a turnaround situation that could add value to it in the long term. And this is a reason why you want to be able to look into a stock. In terms of gossip, yes, you could listen to stories about insider buying. It could also be a thing you'd be hearing about takeover targets. It could also be aligning itself for a special nice cash or stock dividend that may be coming out. Or who knows, maybe they're rumored about this company entering into a new deal or contract that will be able to catapult their business line into something that's a bit more formidable. Now, when you look into the technicals, whatever it is that you're using, the technicals should become your filtering screen here. And the reason you want to filter this is because you want to make an assessment of what you're jumping into. Since technical analysis allows you to be able to trade and make the most of time out of it, then timing issues are the ones that you have to make filters for. Is the stock in an uptrend first and foremost? Can you imagine if you're buying a fundamentally good company, every day that stock drops becomes even a better price point for you because it becomes cheaper. However, the technicals would argue that as that continues to fall down, a downtrend is still very much in place, and it could take a month, it could take 2 months, it could take 1 year, it could take 3 years before that stock were to be able to finally climb up, right? So you want to be able to use many of these technical conditions to filter your trade. Is it breaking out? Are you now in a support condition where it might be a potential buy? Are the indicators telling me or aligning for a potential buy point? Or who knows, maybe some of diverging signals in your indicators are telling you, okay, enough is enough into this decline, it might start to reverse. So the technicals are there to police what you do with all the others and make sure that you follow these systems well so that it can try to take hold and try to prevent your emotions from taking too much out of you. And so try to be able to understand that the technicals here are filters. It's up to you if you want to buy a stock using fundamentals, but use the technical filters to be able to do it. Another way some people could say it is, I choose my stocks fundamentally, but I time my entry and exit technically. And that's where the complement becomes quite useful. All right, there should be two reasons why you want to be buying your stock. And the technical conditions really are drilled down to two. The first is what we call a valid breakout. Now, if you recall in an earlier session, a breakout is simply a wind up in prices in an area pattern, and you will see prices bust or force its way above the resistance line, which is what you see over here. And this breach of that resistance after a wind up is what we call a breakout. Now, the reason I put the term valid here is because some of you might want to be able to confirm that. It could be a breakout that has volume. It could be a breakout that has a certain price. It could also be that the momentum signals are starting to be with you. So try to be able to confirm the breakout condition so that can lend a hand in making sure that this is more likely to move in that direction. Now, the second thing that you also want to look at is obviously the support rebounds. Now, the reason why support rebounds are also quite good is because it actually gives you a good risk reward. And the reason is because whenever a stock, let's say, rebounds from here, coming off a major support area, you know that there's a heavy amount of demand protecting the stock from falling. And so if you buy it at around this price, this is the maximum amount of risk that you're willing to take. Right? In a breakout condition, it's a bit more riskier, only because you have to be able to buy the stock as it's already moving up. And if the prior low will all the way down here, or let's say later we'll introduce a system to stop it at the mid zone, it's a little bit more riskier, but the potential for it to move up is still quite substantial. And it's the reason why we look at this as a potential buy, and rebounds from support as your next potential buy. All right. Aside from these common entry conditions that we want to look at, now we want to add into the filtering element. Now, in the last webinar, we talked about technical indicators, and I want to show you how to be able to add these two together. Now, since we talked about the moving average, the MACD and the RSI, let's just lay all the three out. And now, assuming we have a breakout condition happening, or we have a support bounce taking place, we will now consult these three indicators to see if they also are suggestive that we should take the trade or not. And now, assuming that we use these three as our added three different guides, now let's look at it as if it were a checkbox, and we will ask the basic question. Is the stock price above the moving averages, particularly the ones that I am following? So for example, if I am trading in the short term, then you should be consulting the 20-day or 50-day moving averages. If you're looking for something more medium term, then maybe you want to look between the 50, 100-day moving average. And if you want to look at something longer, then maybe it should be over 200 or 400-day in terms of the moving average. So I'm assuming, let's say I'm trading into the short term. So now my question is the stock price trading above my short-term moving averages, which is a 20 and 50-day? If they are, then I will put a check mark here. Next, we go to the next indicator, the MACD. Now, if you recall last time, MACDs will give us a buy or sell trigger, plus it will also tell us whether it is above or below what is known as a zero line, which tells us whether it is a positive or negative trend. And the buy signal we want to get is a buy signal that comes that also is above the zero line. So do we have a buy signal above that zero line? And if we do, then we will put a check mark here. If I have a buy signal that's below the zero line, then I will put this X. Or if I have a sell trigger, I will also put this X. And finally, we have the RSI. Now, in the RSI, you're going to ask yourself two questions. One, is a stock overbought or not? And two, do I see divergence? Okay, so if I see, for example, an upward moving stock and I see it's not overbought, then maybe I can put a check mark here. And also, is that upward move showing no divergence? Now, if I see it's either overbought or it shows divergence, then I will put an X mark, and that means no, it doesn't fit the situation. Once I put my checks or X's in place, now you will make your assessment of the condition. Let's use this color code to give us some better regard of that. So the stock I'm getting ready to buy happens to be showing you that prices are above the moving averages you're following, check mark. If it shows you a buy MACD above the zero line, another check mark, and an RSI that's not overbought and shows no divergence, then another check mark. If you get three checks, the three checks give you a green light, that means go. Go ahead and buy this stock because it's confirmed by your three indicators. All right. Now, let's say you get an imperfect trade. an imperfect trade means you don't get all check marks here. So let's say, for example, you get one check mark, but the other two says no, right? So that means you say only one indicator is in my favor, but the two say no. So since only one indicator is in my favor, that shows me a red signal that tells you not enough confirmation to make this a viable trade. And so I will hang back from that trade. Okay. Now, if you get something in between where you get two check marks and only one cross out, then you get a so-so trade. Now, you may take those trades or not. That's not really up to you. I think your expertise here will tell you which ones you can be a bit more early. But all that simply means that if you get a so-so reading that one of these things are not in your favor, that means that be prepared that you might get a little undertow there and that some choppiness might come out. It will not be an easy trade to be able to make. And that's why I would regard that maybe more of the stock experts might want to be able to take entries from so-so type of filtered trades. Now, if you do all your filtering and you have a breakout or a support rebound, plus you've got three indicators in your favor, go ahead, take the trade. If you have a yellow reading here or two signals, go ahead. Maybe what you want to do is reduce your volume just in case so you don't get too much shaken out. But if you only get one reading, look for another stock. This is not what you want to be looking for. You want something that will give you better hand of what's about to happen. And having too little indicators in your favor means that you're coming into a non-viable trade. It is an imperfect trade, and do expect imperfect results. Okay, let's try to be able to make an assessment of this. So I know that's all concept. Let's put it now into practice. So let's say, for example, I have a stock here. This is Maxis Group, and I have it plotted out against a 20, 50, and 100-day moving average. Now, it's coming off a declining trend here, but I want to show you that the downtrend line has been broken. And so we got a little bit of a resistance break here, and now prices are pushing towards a 50-day moving average, but has not broken it. So remember, short-term moving averages are this one and this one. So if I'm a short-term trader, I want to really see that these two moving averages are broken before I start launching myself into an issue. Excuse me. Now, let's check. What am I trying to make an assessment of? So in my checklist for situation number 1, I have a potential breakout condition from a downtrend, right? And I have prices standing below the moving average. I have my MACD here, which is showing a buy signal. However, it is below the 0 line. And 3, I have the RSI, but it's not triggering an overbought condition yet. So let's try to put our check marks on this list. So I'm dealing with a breakout situation, the breakout from here. Now, my moving average is telling me no, prices are not above it yet. So I put an X mark here. My MACD is showing me an imperfect situation because it's a buy situation, but it's below the 0 line. So I will also put an X mark here. And the RSI is telling me it's not overbought yet, so it doesn't look that stretched. I put a check mark here. So if I tally up, 1 X, 2 X's, and 1 check mark, that's only one positive flow with me, and that gives me a red mark. I will not buy this as of yet. Let's wait for the second situation. Okay, so what happens now? And if you had followed do not buy this, look what happened to the stock. You notice it fell back down. See, this is the reason why sometimes you really have to give it to what the moving averages are telling you. All right, now we're in a second situation. And as I draw a new downtrend line here, we have another punch out in terms of prices. Furthermore, before this punch out in prices, look what happened here. Prices recovered first. They consolidated right underneath the trend line. It showed a higher low than the previous one, which is very important. That shows you support has just been raised here, and that it also will limit any risk you take, especially if you're buying in this area, because your risk is no longer this low. Your risk is now raised to whatever the previous low was here. Okay, so let's try to analyze the situation further down. So it's now attempting to push off the moving average, but your MACD still in buy mode, has not gone over the 0 line yet. And the RSI tells me it's not overbought either. So let's do our check and X's again. So here we still have a breakout condition because you're breaking off from a downtrend line. We're also coming from a support bounce because it made a higher low over here, which is also good. Next, the moving average, since it's prices seem to be just jumping off it right now. That gives me now a positive check mark. But the MACD right now, it's still not what I want. So I put an X mark here, and the RSI still tells me that's fine. It's not overbought. It looks something I can look at into. So now I've got two indicators in my favor, the moving average and the RSI in my favor. And so now here's that so-so capacity. I would suggest you take it, but again, like I said earlier, reduce your volume because it's not a picture-perfect trade. But just in case you want to be able to launch yourself a little early so we don't have to pay maybe a big price just in case it continues, at least you were able to put in some position in here. Now let's see what happens to the stock. So look what happened. So it punched out, it tried to free itself for 2 days, and then it failed and it shot itself back down. Now, remember, when I buy this, you will find these rules later when we talk about support stops. I will still not sell this issue unless I am told to get out. And the reason for that has not been shown yet because the support is still down here. So I will try to hold on to this. But now the question I would ask is, assuming I didn't buy this because I was presented this so-so situation, what would be my next window to try to buy? Now let's make this assessment here on this third attempt. On the third attempt, it did pull back. It did show a higher high than the previous one. All right, but prices did come out to be able to move here. There is no breakout from a downtrend anymore in this case. And as we check the MACD, the MACD is actually breaking over the zero line now. You can see it's slipping over. And the RSI is telling me it's not oversold as of yet. So let's do our checks and pluses here. So what am I buying from? I'm buying from a support rebound, my moving average in my favor because price is now moving above it. MACD is also now positive, and that also gives me a good reading. And the RSI is telling me it's not overbought yet, which also tells me a good reason to be able to enter. So now I'm in a situation where I've got all three indicators in my favor, and all three indicators raise a green flag. And that tells me that looks like a much more better opportunity for me to be able to buy. And let's see what happened to the stock. And so you can see, as if things are more aligned, the tendency for prices is to move into the direction that you really want to do. And that really gives you a good avenue of why trade filtering becomes very important. So remember, I'm trying to look for a reason to enter. Now, you might find some imperfect conditions every once in a while, and that might be able to lead you to be able to make a very good estimate of whether you think this is going to continue or not. Experience will count in due time, but allow the trade to be able to be filtered through your indicators so that you can make a good assessment of your environment. And as you can see in this case, if I only entered into the third situation, hardly any waiting time, hardly any pain into the downside, and I saw something a bit more robust in terms of the result output. And this is why we have to be able to justify the filter of the trade into this capacity. All right. So assuming that here we are, we've managed to be able to understand a bit about entry and how we're going to refine that into that condition. Now we're going to ask our second question. All right. How do we know where the stock's going to go? I mean, okay, it looks like a good buy, but does it have any serious upside for me to be able to consider? And could that be the reason why I'm being pulled into this particular trade? So we have to make an assessment on how high this can go. Now, some of you might say, can't I just use the fair value of a stock for my target? Well, yes, but let's make sure you understand one thing. If it is technical analysis that pushes you into a trade, it should be technical analysis that gets you out of one. If it's fundamental analysis that gets you in a trade, then it should be the fundamental reason to get you out of one. So you can't just interplay things whenever you feel it to be convenient, because then you don't have a plan. You're just making things suit what you want to see. And that does not challenge you and does not work up the environment to which to be able to prepare yourself, because you need to have the stipulations up front to control any damage that may come out. At the same time, you can put whatever you have emotions in check. All right. Now, how do we make an assessment of where a stock can go to technically? So we got three ways of doing that. We can look at trend line projection, the high band of a channel or targeting next resistance, or you can also measure a height of an area pattern if you see one. Now let's try to make sure that we look into that type of condition. Okay, So let's have a look at this example. Okay, so here's Semirara. I took this off. This was sometime in 2017. Now, we want to be able to put these three assessments of targets into the condition, see how we can actually use them. Okay, what is trend line projection? Now, if you remember, a trend line is a line we draw by connecting as many of the lows that we see along a trend as possible. You can actually use your moving average to help, right? The ones that seem to be following your support. It could help you to make an assessment of whether that line should be drawn. And I'll just draw it for you. Okay, so for the meantime, but on the sense, you can see that the moving average is also serving as a good gauge for that supportive area. Now here's where the trend line is based on the lows to the next lows, and I've just extended it to the right side because I just wanted to see where the support levels will be. Now remember, when you draw a trend line, the area does not have to touch it absolutely to the last dot. Okay, it should just be as a general ballpark figure, including your moving average. It doesn't have to actually hit it exactly, but if you're talking about only a very minuscule price away, then that is acting as a support element. This cannot be too exact anyway. All right, now the point we have here is, I want to know how high this stock price can go to. And assuming I only have either a moving average or this trend line, which I've drawn in conjunction with that moving average, I want to be able to get a sense of how far should that particular stock price move. Okay, now have a look at this. We're currently standing at about 37.50. Now, if I buy this now, how much or how high will this stock price climb in, let's say, the short-term future? So let's try to count it. Let's say if we go all the way up here, where will prices be sometime in September? So all I do is I start with this trend line that I have, and I will now extend the trend line, and I will just draw it the same angle over time, all the way roughly up here, like so. And this gives me a projection of where the price should be in the minimum, assuming that this uptrend continues in the pace that it is climbing. So just by this alone, I can tell you that if I'm buying it here in May, then I'd forecast and I can try to say that over the next 4 months, let's say 1, 2, 3, 4 months from now, this price should be closer to about 41.98 or closer to 42 pesos per share. So now you ask, okay, is it okay if I buy this on 37.50 to realize a gain of about 42 pesos in 4 months' time? And that's where you can make an assessment of what that is. Now remember, a trend line will give you the low end of the price because this is where major support is. It will not fall below this, assuming this trend continues. Now, as you can see, prices do jump up and down within this uptrend. And so this is your low band. And let's try to be able to estimate what the high band of that will be. How do we do that? We draw a price channel. So we do a price channel by first looking at this uptrend line that you have. We will copy the same angle that you have and push it up into the high bands of what you see up here, like so. And with that, remember, I'm copying this blue line here and I'm putting it right above where pretty much all the other highs are. Doesn't have to be exactly where it should be, but just in the ballpark area. And this gives me the high band of price. So if the lowest point for 4 months from today will be about 42, the highest price should be somewhere closer to 46 or 47 pesos. Again, let that now make an assessment in you and say, am I willing to buy this now at 37.50 with an upside of 42 to 47 in 4 months' time? And if that's viable enough for you, then you can take the trade and try to make that particular price projection make things work. So if you don't do something like this, how do you intend to understand what you're gunning for when you're buying a stock? If you're not using the fair value and you're using something on the technical aspect, you need to be able to get that sense of range. If I don't know where a stock is going to be, that means I'll be buying it and just be saying a prayer and hope that it goes up 10, 15, 20, or 50%. That's not viable. And that will not always happen, no matter how hard you pray. Right? So you have to make a good assessment of what the capability of the stock is, and you have it all there in the element of your trend. Third, the height of an area pattern. Now, sometimes you will get area patterns that build within this uptrend that you see. Let me show you one. So here's an example of a consolidation in price. This is known as an ascending triangle. You can see the tops are relatively flat, the bottoms seem to be escalating or climbing. So given this particular type of condition, what am I now looking for is a potential for prices to break out and go above. Because if it does, then this measuring size that I have over here, the size of the consolidation, will climb up by a minimum amount of that same size. And that can also make a good estimate of where prices can be into the short term. So if we see a breakout price, then you can say this should go up to about this price in the minimum, maybe even better. Okay, so the height of an area pattern can also give you a good estimate of that range. Now let's see if prices did actually reach it. All right, so look what happened. After this pullback in price, it found some degree of support near the trend line. It jumped up again. And if you look at the trend target we were looking at, it hit it almost smack to the target. And after it hit that, look what happened to the price. It started to be able to wind up all over again. It actually built a new area pattern. Another triangle was built. So we do the same thing all over again. So just in case prices break above this range here, we will look for a potential buy. Our upside will be a minimum of whatever the size of the area pattern was. So if this is the size of the pattern, then extend it from the breakout price and look at where the stock price happened to be able to hit as a potential target right before a new correction comes in. All right, and after that, in fact, another consolidation is actually being built here. So treat this like it were a staircase. As an uptrend moves on, you can actually estimate the highs. The high band did work well in this particular case. The estimate of the area pattern also suggested a potential price target for you. And if you want, did the stock price actually hit that 42 to 47? This actually hit 48. So if you looked at this, either one of the measuring formulas that we looked at here actually worked and should be able to cast you into a stock with that viability. And so this is how we come around to be able to make technical assertions of what target prices are, and that should prove to be helpful for you so you know what you're gunning for. Okay, now let's talk about selling. Now, before I cross into the boundary of selling, remember, trades are made up of two aspects: entry and exit, the buy and the sell. Buying a stock is easy. All right, because you can drill that down into a science. We can build every trading plan that can generate a buy signal inside. And the nice thing about buying, it's only really controlled by one single human emotion called greed. And that's why when it's time to buy, you more likely will buy. Okay? Now, yes, there might be some apprehension inside, but the overwhelming sense of greed really outmusters everything else. And that's why it's easier to buy a stock than it is to sell a stock. In the selling part, you've got every emotion available bothering you. When you sell a stock, you're either selling it at a profit, or when you sell a stock, you're selling it at either neutral or at a loss. Okay? As those circumstances flesh itself out, you're going to feel greed might be there, fear might be there, anticipation, dread, you name it, you will feel it. And that's why, it's very easy to say where to buy a stock, but it's much harder to say when to sell a stock. And that's why 9 out of 10 traders will have the selling of a stock as the main problem in their trading plan. It might be listed out there, but the tendency for them, because of their emotion, is not to follow it. And I noticed many of you have answered that you did not follow your trading plan. And I'm almost sure that what you did not follow in your trading plan is the selling plan. Right? Buying, I'm almost sure you bought your stock, but the selling, that's where the hard part comes in. Okay, so we choose to sell a stock either to take some profits or to be able to get stopped out. Now, when we say stopped out, what does that mean? That means you're going to be selling your stock because of a particular circumstance. Now, when we take our profits, let's try to be able to inject certain types of rules as well so that we can control what we do here and we don't just sell when we feel like. Some of you maybe have that. You answered, I sell based on my gut feel. Well, for those who don't have such a good gut feel of the market, that may not work for you. If you now become a seasoned trader and you don't even want to do all these calculations or pre-planning, that might not really be a bother because your mind has already gotten used to it. You've already made it a habit to yourself. And when that becomes innate inside you, you really don't have to write anything down. It just works everything very, very well. Most of the expert traders I have, that planning goes on at a microsecond in their head because they're so used to doing it already, and they can call it up on a fly anytime they want to. All right, when we come inside to be able to take some profits. Now remember, when we take a profit, it doesn't mean that I have to liquidate my entire position. In fact, I advise against it. All right. So when you take profits, you want to take a portion of your profits only. So for example, maybe sell 30, 50, or 70% of your portfolio or your position in that stock or index. More likely 30 to 50%, unless something major had taken place to be able to say you better sell 70 because I want to take advantage of an extraordinary situation. So normally it's about 30 or 50% that you want to lighten down to, and that really depending on the aggressiveness that you flesh out onto your trade. Remember, I'm taking profit here only because I see an opportunity that prices may have gone up a bit too fast too soon. And I still believe that the uptrend will continue. That's why I'm still keeping a portion of my money, of my position intact. All right. And so looking at that, if this stock comes out of that extraordinary situation and comes back maybe to a support area and it rebounds from there, I will try to buy that position I sold back. Okay, because my contention over here is I'm going to try to stick with that trend as long as I can. Now, along an uptrend, I might just get an incredibly sharp up move every once in a while, and that's where I'm going to take my profit. And when it cools back down and level-headed approach comes back in, I will buy myself back in there because the trend still shows that it should be moving higher. Now, let's talk about stopping up. I'll give an example of these two into the next slide. Now, when we say stop out, now we get stopped out. Now, a stop out condition means that more likely you have a support area that you've identified, that you've strongly felt was not going to break. Yet, the prices have breached that particular threshold. And because of that breach, it could be that the trend you were looking at no longer exists, or it could be that it's showing a much more viable downside that may begin from here. So given that condition, it's time for you to unload your position. Yes, sometimes that could still lead into a profit, but sometimes it could lead to a loss. So if it leads to a profit, you can still call that a profit-taking maneuver. But if it leads to a loss, we call that a cut loss maneuver. Right? So a stop loss could actually lead into one of the two circumstances. Now, once I get out of a stock position, I am not there to look to buy that back immediately, because more likely I sold that because the trend more likely has changed, has slowed down, or something wrong has happened to it. So I will only buy that back if the uptrend comes back, or if I see a new setup or new trend condition that's favorable to me is restored into the situation. All right, so remember, take profits is selling a little bit, and stopping yourself out means to liquidate your position all in all. Okay, let's try to be able to demonstrate that condition out in our example here. Okay, we talk about taking profits. Let's start first about reaching your targets. Now remember earlier on we were saying we have to assess how high a stock can go. So if I took all this trouble to be able to plan out how high my stock can go to, and finally I see my stock price hitting that particular target, I shouldn't just gawk at it and say, wow, I'm doing the right thing, I should hold on even more. Who is making that decision now when you decide to do that? That means you bought a stock at a certain price. Let's say you bought a stock at 10 pesos and your target was to sell it at 12. And now it hits 12 pesos. And now you somehow convince yourself and say, no, 12 is not enough for me. I want more. And so you don't sell. Who's talking here if not your emotion, right? And greed is now taking over any risk element that is supposed to be in control at the same time. So we have to be able to lay out the foundations of where we're going to sell a position, and we have to do it when it's timely. Okay, let's have a look at our sample here. So here we have a Manila water move, and into this uptrend that you've seen, you see a wind up of a new area pattern looking like a wedge. Now, let's measure the size of the wedge over here. That's about 1 peso and 80 cents in size. And the breakout price, which it did over here, was about 25.90 or 25 area here. So the question I'm going to ask myself is, should I take this trade, right? If I say yes, then if that goes to the target price that I'm looking into, so that what would that be? That's 25.90 plus 1 peso and 80 cents, and this is your target. So now it breaks out, you go ahead and buy it, the stock price hits your 227.70 target, and now you have to ask the question, do I sell? And the answer is, well, you have to take some profit. And so whether it's 30 or 50%, I'll leave that up to you, depending on how forceful or how aggressive you are into this condition you see of the stock that you're looking at. But 30 to 50% is a good start. You will know one day which one to choose as you do that many times or more often. If this is normally coming from a bottom, then you probably want to take off a 50% move. But if you are in a strong uptrend, you probably want to do only 30%. Because remember, the stronger the trend, the more viable it is, and the more likely you're going to see a new high down the road anyway. All right. So once I come inside and take my profit, I will now wait for an opportunity to buy this back. So I will assume right now that you've sold 30 or 50% of your position, and now here we go, a correction comes in and comes closer to my supportive area. If my supportive area holds and I see another breach or breakout here, then whatever I sold up here, I'm going to buy this back into the next opportunity. Okay? Remember, since the uptrend is secure, you're looking for an opportunity to buy that back. That's why we're only taking some profits and we're not liquidating the whole position. Now, once in a while in a blue moon, you're going to find something like this, and I congratulate you if you ever have one. This is what we call windfall gains or windfall profits. When you have windfall gains or profits, I would really recommend that you take them. And the reason is because more likely, this very, very abrupt movement that you would see in a price, just like what you see here in the sample of Nickel Asia, more likely was brought about by something that people were not aware of. And people are all rushing to be able to buy that all the way up to that next high point. Some may be getting it at the low price, which is good. Some may be buying it somewhere in the middle, and some, maybe even more, are probably buying it on the top end of that particular range. And you can just imagine what that can bring out later. So given the context of that, we're not going to be able to look at the potential to make money here. It just doesn't happen every day. So when you have it and you get the opportunity, if you see over here, after the breakout at 260, in a matter of 3 days, the stock price hit 5 pesos per share, right? I mean, how often do you see something like that in the stock market? But if you do, you have to understand that more likely, I would say 9 out of 10 times, this will not last up there for a long time. A correction will come back, all right? Now, given that condition, I would now recommend that you look to take maybe 50 or 70% of your profit when you have extraordinary gains like this. Now, when I say windfall, these numbers are supposed to be very much out of the ballpark. So we're talking about something that could exceed 5, 10, 20%. Those are windfall profits, right? And in this particular case, it almost doubled its price in 3 days' time. I think that's quite clear that that was windfall gain for you, and that would have been a good attempt to be able to take it. Now, you also want to be able to understand that you're taking that profit because you're trying to safeguard the profit that you made, and that if this were to make a correction and just go back to support and show you a new opportunity to buy, you can always buy your stock back. All right. Now let's try to be able to give ourselves an example of a profit-taking maneuver and a buyback maneuver. Here we have pure gold. We have an uptrend. Now, we have a breakout condition from an area pattern we see here at the bottom, and we execute, let's say, a buy signal here. Now, I drew this over a moving average, the red one, which is a shorter-term moving average. I also laid out the RSI figure here in the bottom to give you a good sense of whether the stock is overbought or oversold or not. And I want you to be able to see a little of the indicators that it had. So clearly it goes up and down within the set band. Now, let's have a look at a few readings here. If you notice the RSI, the red arrows show you areas where overbought conditions were fleshed out by that indicator. And it all came because stock prices moved up very sharply. In this case, it went up here. In this case, it went all the way up here. And of course, in this case, it stretched all the way up, first from here, and then the second one from there. Now, I'm showing this to you because when you see the overbought condition, this is where it's time for you to say, all right, maybe I should sell a little bit. But since the uptrend here is still relatively strong, in a case like this, maybe 30% of your position should be okay to take some profits on. And then if the price settled down and you see either a consolidation or a whip back to support, you should look for an opportunity to be able to buy those things back. Where would those areas be? So for example, take a little bit of profit, buy it when it breaks out of this, since it's closer to support. Take a little bit of profit, buy back when it rebounds off your support. Here, take a little bit of profit. It decided to be able to consolidate for quite a number of months in this particular case. So you could have saved some money. You could have traded something else while this was consolidating. And now you're seeing the conditions that are showing a new setup, and it breaks out of that, and you can buy your stock back here, and you can take some profits either here and here, and wait for a new pullback to be able to handle it. Now, look what happened here. Now, in this case, the price fell back, but it broke through the trend line, and it also broke through your moving average. It did jump back above it a little bit, but not by a serious amount, and it only really amounted to a sideways move. That automatically gets me into a very worrisome condition, because it's threatening that this main uptrend that I've been following here is now under threat. And if this uptrend were to break by more of a decline in prices, then it's time for me to get myself out of that condition. So here I would have sold maybe 30%, 30%, 30%, buyback, sold 30%. Here I would have waited before buying back. And if prices continue to break, whatever I had left, I would have unloaded it into that situation. And so this is where the profit taking and buyback condition should be able to present itself to you. Remember, you're only selling the position because you see an extraordinary gain in a very short period of time. You want to take some of that meat back, but you want to buy this back as long as the uptrend remains intact. And you will only liquidate the entire position when you see a change in trend or a drop of major support. That's the only time that you unload this. Okay, so let's talk a bit more about being stopped out. What signals can we use to be able to highlight those stop out moments? Well, a break of your trend line or moving average is a good indicator, because that suggests a break in trend or support. Any breakdown condition is also something that you should look at. Now, let's have a look at these two conditions first, and I'll look at the third one into the next slide. Now, a trend line or moving average break. So here we have it. So we have an uptrend bouncing off support, bouncing off support, bouncing off support. So as long as you see all this very much intact, there's no need to be able to sell out your entire position. You can take some profits on the extreme conditions you have over here, but please buy them back when you see support rebounds from your trend line. Now, look what happens here. Your trend line cracks, the moving average breaks, and just before this happens, that tells you already a warning sign, and that says unload. And good thing that we follow this, because if it did that, you look what happened to prices. So it's very important. Now, if both of you, if you want confirmation from the two to happen, you can do that. You can say, I need my trend line and my moving average to break to be able to tell me to get out, if you want to be that fussy about everything. But look, at the end of it, whether you follow this or whether you follow this, it would have prevented any loss out of these 3 huge decline days that you've had. So keep watch of trend lines and moving averages. Remember, because they're breaking because trends are changing. It doesn't mean that an uptrend breaking automatically means it's going to go down, because remember, there are 3 trends. It could go sideways, but remember, you're not buying a stock for it to go sideways. You're buying a stock because it's in an uptrend. And so if that uptrend no longer exists, I should be taking my position out and looking for another uptrend out there that should mark me up much faster than a sideways or declining market. A breakdown condition. So a breakdown condition looks something like this. So again, we do have an uptrend line here. Our uptrend line broke. So if you followed your trend line, you could have gotten out here. Some people, though, would be bothered because many times after a trend line break, there is this ability for prices to rebound, retest the high before actually turning the trend. And I explained that also in my 2 webinars ago, when I said that area patterns normally do that, retest of the highs and lows after a trend line break. And so in this case, a consolidation pattern was built. But on this moment here, when prices ruptured through that floor, there should be no excuse for you to be holding that position anymore. Your trend line told you to sell. Now your area pattern told you to sell, and that major support break is a violation that we have to listen to. And look what happened to that stock afterwards. So please, any trend line break, moving average, or area pattern break or major support fault that should be able to narrow down or pulling that position out altogether because you're trying to safeguard whatever you've made so far. Now let's talk about this third type of stop out condition called a trailing stop violation. Now we will use this by also understanding marking out areas of clear support and what I call looking for last reaction lows. So let's have a look at it here. So we have a situation where we have Ayala Land climbing up, as you see. Now we do have a reactive trend. Prices break out of that, which a potential buy comes in. And let's just see a downtrend, recovery, retest of the low, area pattern being built. Breakout came in here, so you look to buy. Now we have an uptrending environment taking place. Now how do we set up our conditions over here to be able to ride this through? So assuming we're entering somewhere over here, let's not look at some of the technical indicators we have or classical indicators to help us make an assessment of this. Okay, so the first thing I did is I just wanted to generate based on support and resistance alone, whether I can create a system to help me protect myself every time I enter the stock and to see whether after every reaction, whether I can raise my support into the next level to protect whatever profits I make. So if I bought this stock here, stock price goes up. Now remember, I will not sell this unless my support is broken. After this breakout price itself is support. Remember, an area of resistance once broken becomes support, the reversal of roles. So as prices breach, you buy. It corrects. It does not go back below the breakout price. So that means you don't sell this. Then an area pattern is made. It consolidates for a while, winds up, breaks out again. Once a breakout takes place, I will now move my support area from here, and I will now move it into the next level where prices broke away from. Now a new consolidation is built. This is now my new support level. It consolidates up and down, up and down, up and down, and eventually it breaks out from that new range all over again. Once it breaks out, I will now generate this area. It used to be resistance. I will now use it as support. And now prices attempts to make a reaction, and it doesn't break that supportive element yet. So far, whatever I bought here, I have not gotten stopped out because the support areas have not broken. This has held, and so far this is holding. Now, prices rupture over the previous high, so this used to be resistance. I now use this as support, and prices climb once again. And if you notice what happens here, eventually the stock price does break my support area, and it's in this case, I liquidate my stock position. So here's what we call adjusting or trailing my stop. I'm raising it at every opportunity I can whenever I spot a new support so that I can protect whatever profits that I've realized so far. Now, you can also use a system like this. Now, I call this looking at the last reaction lows. Now, what that means is this. Into an uptrending situation, I will simply look at every upswing, where was the last correction it made? What was that last low? And assuming it didn't break my original support area. And after prices rally, I will mark off that area as my new stop. In other words, to me, this is major support now. It winds up, breaks out, okay? And I can just keep doing that, raising and raising. In fact, you probably could have done it here as well. The prices went up, went to a new low, went to a clearly low here, broke out again, raise your stop to this previous low, pushed up again, corrected, pushed up, raise your stop to this last reaction low, again here, reacted to this level, raise your stop into this area, and the minute this breaks this low here, I sell my position. Now remember, I can't stress the importance of adjusting your stops along a trend, because if I were to just say I buy this and as long as this doesn't break, I will not sell, what happens if this goes all the way up here? And in this major correction, let's say it's in this major correction that it actually breaks through that to that low later on. So what was the whole point of trading all of this where you could not even keep the money that you made? Right? So adjusting your stops upward becomes very important. This is how you pocket your money. You put a safety net to the profit level so that it's not taken away from you. You've worked so hard for it. Put it in your pocket. And this is how you create the safety net to do that. Also, trend lines can also be used. For example, if I bought over here, a breach of the trend line can tell me to get out. Right? So I take my position out first. And why? An uptrend became a sideways trend. Now, in this sideways trend, it broke out from here. It generated a new advance. And so now I can now start drawing a new trend line. If I'm short term, I will just make it this advance. If I'm more longer term in my orientation, I can draw a new trend line which connects two major lows and use this as my selling instead. But assuming I'm a short-term trader, I will follow the lows that I see, and thus on a break of this level here, I will sell my position. So that means in these swings that you see here, I would have bought here, sold here, bought the breakout here, and sold the breakdown of the trend line here. And that's how you adjust your stops upwards so that you can protect the profits that you've made. Now, we also talk about evaluating your prospect. Now, when we talk about your prospect, we're talking about how, when I'm buying this stock, how do I know that this amount of return is going to be justifiable for me? And let's say, for example, let's say you're looking at a potentially strong market, and you have 5 or 10 stocks to pick from. They all look good. But now, of those 10 particular companies, you now start to go to each one and say, which is more viable for me to take? Well, the answer to the question should be this. Whichever one of those 10 shows me the lowest risk and shows the highest reward, that is the stock I should pick. Because believe me, it will happen once in a while. You're gonna get yourself into an environment where you'll have a lot of stock picks to be able to choose from. And it's like walking into a candy store. A little kid who goes into a candy store and he just looks around and sees, my God, you've got small lollipops, big ones, gums, you've got sugary stuff, chocolate, you've got everything to pick from. And you probably walk into a candy store and you just don't know which one to pick. And so, I always joke and I tell this story that here comes a little kid, he starts pulling all different types of candies, chocolates and whatnot. And he puts it all in his 2 arms like this, holding it to try to be able to bring it to the store counter. But on his way out into the checkout counter, he sees this massive chocolate that he says, wow, I want that. But remember, he's holding a whole lot of things already. And so in an effort to get that beautiful looking chocolate, he moves one of his hands to be able to pull that chocolate off the counter. And in doing so, he opens up an opening beneath him and all the candies that he was holding falls down to the ground. Now, the learning lesson in all of that is you can't have it all. And if you try to do that, all the other opportunities will fall below your hands. And so it's important that you just come inside and say, all right, these are my filtering schemes. This is the one that I want the most. As a trader, you should have maybe 3 to 5 stocks the most at one time. Ask myself, if I see that in my portfolio magically appears I've got 6 stocks or 7 stocks, I know already I'm just buying too many issues and I am not focused because I'm not picking anything inside there. And it shouldn't be that way. Pick 2, 3, 4, 5 stocks max. Those should be able to get you to where you want. If you're buying too many, that just spreads your attention too far up and you can't concentrate with what you're doing. All right? So evaluate your prospect. When I'm looking for a potential stock, ask yourself, what's my upside versus my downside here? And try to assess what is their potential reward versus the potential risk of taking this trade. Let me show you how to do that. So let's have a look at this chart of DMC. I also have what is known as a wedge pattern over here. Now, the size of the wedge pattern is 1 peso and 50 cents. So the size of the pattern is this much. The breakout price is at 6 pesos and 80 cents. That's this area over here. So ideally, I should be looking to buy this. My potential upside should be my breakout price plus the size should be this particular target. So let's say it's 8 pesos and 30 cents. So now I want to make an assessment. Is this giving me the risk reward or reward to risk ratio that I want? When I buy a stock, I want at the least that my potential upside is 3 times bigger than my risk, right? So for those who call it risk reward ratio, it could mean for every 1 point of risk that you take, it should come with at least 3 points of reward or better. Put that in peso terms, if I'm buying this stock and it falls below my support, I will lose 1 peso. And if I buy this stock and it goes to my target, I will make at least 3 pesos. And that's the kind of risk reward that I want in this particular trade. So how viable is this trade? So I know my breakout price. Now I want to know what is my support. Well, I have two ways of gauging my support. The first, or support number one here, is my breakout price is my support. So 680 is exactly that price. So if, for example, you buy a stock and who knows, maybe you waited a little bit off 680 to confirm your breakout. Let's say you break it at 682 or 690. Let's say 690. Let's say you were not that quick. And if you buy this at 690 and your 680 is your downside, then you only have a 10 centavo risk. Whereas what's my potential for an upside? 690 all the way up to 8 pesos and 30 cents. That's huge compared to your risk. And that's probably a trade you want to take. Now, sometimes I want to be able to give certain patterns some leeway. And so what I do sometimes is that if I see an area pattern and prices do come back into the area pattern, normally a lot of traders will square their positions off if that happens. But depending on the pattern, especially if I see a bullish pattern like this, what I do is I will now measure towards the final end of the pattern. What is the size on the final end of the pattern? I will get a 50% value on that, so the halfway point. And that 50% is what I will use as my second support area. And I will use that, let's say, to be able to measure my potential risk, whereas as what my potential reward will be. Let's try to make that assessment here. Don't worry too much about the numbers. I'll walk you through it. Okay, so earlier we said my target price was 8 pesos and 30 cents. Okay, my buy price was at 690 because I was not able to get the 680. So that tells me from 690 to 830 is a difference of 1 peso and 40 cents. 140 is my reward. Now, let's try to measure my risk. If I had bought it at 690, which is right above the breakout price, and it happens to be able to fall to my support number 2 here, which is at 660, then my risk would be 30 centavos. So let's check. 140 reward versus 30 cents in risk. So how many times bigger is my reward compared to my risk? It's 4.6 times greater than my risk. So my risk reward ratio in this case would be 1:4.6. That's clearly bigger than this. And so this is clearly a viable trade for me to be able to take. All right. Let's say, for example, you're looking for a potential breakout. Your breakout is at 10 pesos per share. Your target is 11. So that means my reward is about 1 peso. Now, my support, let's say, happens to be next after the breakout price is all the way back up to 9 pesos because the breakout started from the base of a pattern. And that means that my risk is 1 peso. My target is also 1 peso in reward. So my risk reward is 1 point of risk versus 1 point of reward, 1:1. Now, I don't like those odds, and I will not trade that stock. I will look for issues that will give me at least a 3:1 or better. And the reason for that is, if I were to make 10 transactions, assuming 50% of the time I make money and 50% of the time I lose. If the risk-reward ratio I get is 1:1, that means on the 50% that I win, I will make 1 peso. On the 50% that I lose, I will also lose 1 peso. In the end, I square off and I don't make any money at all. But if I find a risk-reward ratio that is 1 point of risk, but 3 points of a reward, and let's say again, I find this trade that I'm only successful half of the time. On the time that I lose, I will lose 1 peso. But on the time that I do make money, 50% of the time that I do make money, I make 3 pesos. And so that means in the end, even if I only am half successful in my trades, but I give a bigger risk reward ratio and I'm making more money when I do make money, I will still walk out from the winner only if I still only call this half right. And I hope that if you know your technicals, you're not just going to be calling your stocks right half of the time. You should be calling your stocks right 80% of the time. So if you can have an 80% win ratio plus a risk reward of 1:3, you can just imagine how profitable you can be if you can align yourself with that particular rule of thumb. All right. So now it's really all about controlling risk. I mean, risk is very important. Now, I will try not to be able to make too many numbers here because I don't want to freak many of you out. But I want to, I want you to be able to walk out of here understanding why we talk about risk first. In fact, if you go into the global market, you're going to find that these savvy traders, these experts out there, before they even buy anything, the first thing they assess is risk, not reward. They always check, what do I lose? And they always want to do that because their capital is very important to them. So you want to keep your losses at a minimum. Obviously do not make them at a maximum. Second, capital, or the funds that we have to trade, is our lifeblood here. It's like the oxygen that you put into a tank on a diver who goes underneath water. If you don't have that oxygen, you're done for. You cannot exist in that underwater environment. So our funds are what keep us alive in this game and allow us to be able to make more profit. The minute you sink that value too low, we're not going to be able to make things happen here. And that's why you have to be able to watch out of this quite carefully. Now, I'll lay this out for you just so you can get a sense of it. When you take a trading loss, let's say you take, for every transaction you make, let's say you only allot a 1% loss caliber on that transaction. So for example, if I lose in that stock and I only say for every loss I take maximum of 1%, that means I will have to make 100 transactions and lose 100 times before my money is completely extinguished. If I use 2% as my threshold, so for example, I take a trade and I will only stop it out if I lose 2%, okay? If the 2% becomes a loss, that means in 50 trades and I lose 50 times, then I get washed out. Assuming I lose 4%, this threshold here, and that means it'll take you 25 trades before you get washed out. And clearly, if I use 10% as my stop loss threshold, that means if I lose 10% in 10 trades, I'm done. Right? So it's very important that you try to narrow your losses out and try to choose something that may be within the first 3 numbers here and not the last 2 numbers here, because these might be a bit too big, right? Also, when you lose, I really want to point this out. It's hard to make that money that you lost back. And so that's why you want to put more effort into it, of preventing that from happening. Imagine, if you lose 10% of your portfolio, that means you have to make 11.1% just to break even. If you lose 25% of your portfolio, you will now have to make 33.3% just to break even. And imagine if you lose 50% of your money, that means you lost half your capital. You have to make double your money in order for you to just break even. And imagine if you lose 80%, you have to make 400% just to break even. So please, I mean, you really have to put a safety net into everything here. Mind your risk. We put protective stops for a reason, to control that loss, because we don't want the emotion to get in the way. Many times, it is that causes the biggest losses, though not wanting to accept a small loss that eventually becomes a much bigger loss. And that's why, when you're walking, please don't walk over an open manhole, because that's what you do when you don't have a protective stop. If you don't have a cut loss point, you need to secure that. If not, you just fall right under and you get engulfed, whatever happens there. Now, diversification is important, yes. But to a trader who knows what he's doing, diversification is all about finding the right quality of stock with the right assessment into it, the technical assessments into it. Now, the reason I want to do that is because, for example, if you're looking for a potential buy, and here you are, you're going to be buying, let's say, you're going to be buying Ayala Land, SM Prime, Robinson's Land, and Mega World. So here you're buying so many stocks all in the property sector. If something were to happen into the property industry, every one of your 4 stocks will go down, right? So you might be saying that I'm spread and I have 4 stocks, but the problem, the industry inside might create a much weightier risk. That's like you buying 1 stock all in the same property sector. So try to vary. Maybe you want to buy a property, then a telco, then something else. Preferably what you're buying should be in an industry that's doing well, right? So don't just buy it because it's cheap. There has to be some other resolute reason why that thing should be able to go up. Second, try to run a well-balanced portfolio, okay? And when I say that, remember, you've got big caps, you've got mid caps, and you've got small caps. What is a big cap? Big caps are pretty much all your blue chips. Big companies, proven, these guys are doing well. They trade quite a lot in terms of volume. However, some of them may not move very, very actively into percentage-wise, but some can. Then you've got the smaller caps, and the smaller caps are tiny issues that hardly trade any shares. They could go lightning up and down in a bat of an eye. Sometimes you can see 10, 50% in a day. And I know that might allure many of you and might draw you in, but like a moth to a candle of a flame, you could get burned. So if you want to be able to trade smaller caps, especially for those who are not that seasoned yet, I would recommend that smaller caps should be a contained or smaller part of your overall portfolio, maybe 20% or lower. Okay, distribute the rest into bigger caps, into mid caps, and that way you can try to be able to contain any movements you have inside. Also, do not over diversify. I did say earlier, try to have maybe a maximum of 3 to 5 stocks only. Ask yourself this question: if you are a trader and you buy 20 stocks, why do you buy 20? Because you want to be diversified? I think the reason people buy 20 stocks is because they feel just they don't know what to pick. And so what do they need to help to hit my target of making money? They get a bazooka and they try to hit it, so the explosion of a bazooka brings all the pieces down and they can hit everything with it. But that's a very inefficient way to knock down a target. You should be like a sniper, the guy who takes in, very efficient in his bullets, looking at one single target, picking off 3 or 4 times. It's more efficient. You can make more money that way, rather than throw a hefty amount of money in a blanket of stocks of which that you don't even know what it is that you're going. And I'm sure that's the reason why you're doing that. If you're going to be a trader and you're going to be buying 20 stocks, may I just give you a piece of advice? Why don't you just buy an index fund instead? I think you'll end up probably working out much better, and you'll put less factor into it. So please, if you're going to go into a bazooka type of trade, I think just buy your index stock, and that might just be better for you. For those people who are a bit more seasoned, 3 to 5 stocks, that should be able to fare out well. Now let's talk about adding up to a position. If you want to be able to, let's say, for example, you see a breakout, and in a breakout condition, you're not really very sure about yourself because there's certain things, there are imperfections, let's say, in the technicals, or you feel something iffy about the company you're about to buy. And because of that, you want to take a small step first because you don't feel inclined to put everything all in just in one go. So if you actually buy a small portion of that particular transaction, remember this. I want you to be able to make sure that you're only adding up to a stock position that's making money for you, right? So if you buy your first position and you want to add up because it's making money, fine. But you shouldn't be adding up to a position where you bought a stock and it falls way below your price, and now you're losing money. And your call is, let me buy lower so I can average my price, average down. Please don't do that. I mean, if you're an investor, perhaps those are the techniques you may seek. You're a trader. You should know better. You are a creature that knows and understands a sense of timing. And obviously, you bought something at the wrong price, and as prices are now falling and you're losing, don't add to that losing position because it puts you in a position of disadvantage. Imagine your mindset buying a stock that you're making money in. I'm sure it's all about confidence. I want you to imagine now the opposite. Here you just bought a stock. It fell down. You're losing money. And now you're going to add more money into that. You already don't believe yourself, and you probably thought something wrong. And you're just trying to be able to put a band-aid on something which could actually hurt you more. Because what happens if that stock falls down again? Will you buy more one more time? Will you buy more 3 or 4 more times? Or will you just keep continuing to buy more until you have nothing left to buy with? So that's not the situation we want to put up here. Use what we call the upright pyramid method in adding up to a position. If you look at the image I have over here, assume this trend in price, you see this zigzag movement up in price is your stock price. If you're coming into a potential breakout condition, remember this, your first purchase should be the biggest, okay? This is in your first level 1 zone. Finally, when your stock explodes and starts to run into your next capacity, if you want to add, fine, but your second purchase should be smaller than the first. Okay? And after that, maybe a new area pattern will be built, and maybe another breakout will take place for it to go to stage 3. And into this stage 3, yes, you can add again, but this time I want you to put in a smaller position than what you put in the second stage, right? And you cannot be putting the biggest amount into that third stage, which is the biggest and most common mistake traders do. And the reason is very simple. As the stock price climbs up, the more confident they are, the more money they've made, and the more emotional they become and greedy that they want to make even more. And it's because of that that 8 out of 10 traders normally put more money near the high of a stock than near the entry level of a stock. And that's where people lose up. So please understand what you should do and do it right. Okay, let's talk about mental preparedness here. Now, I want you to understand that when we come around into a market condition, I want your mind to be prepared for what you're doing today, right? If you're not ready to experience what's going on today, there's no way you're going to take advantage of a position. For example, in today's market, we just saw the market go up almost 200 plus points. If your mind was not ready to be able to take advantage of that, you would not have bought a single share. And so you have to be able to come out and say, there's an opportunity here. I'm getting ready to align myself into it. Just like a general, when he goes into war, he surveys the battlefield, and before he starts entrusting his forces to go in a direction, the general will say, all right, hilly, muddy, chance of rain, too cold, and he assesses the environment and he knows what the risk levels will be. And that's what I want a trader like you to become. Assess your environment. What can happen? Is there a bullish or bearish sentiment underlying here? And because of that, that should contain what you do or should generate more aggressiveness. If it's more bullish, more aggressive, if more bearish, you should be more defensive. Second, after reviewing your global surroundings, I want you to localize your view. Okay, so first thing you do when you talk about look at your global surrounding, remember, always look at what's happening in the biggest market in the world, which is the US. Because sometimes when that US sneezes and it comes down a lot, it tends to affect what happens to us too. So for example, the US market's been climbing quite strongly. Let's say in the next 1 or 2 days, it decides to correct off a major up move it did. What do you think will happen after we just shot up, let's say today? It could affect what's happening. You must be prepared for that just in case it does happen. Now, when you say localize your view, you just say, all right, market is breaking out, all other markets continuing to rally. Now, in the Philippine contention, we're now here in an environment of COVID-19. What do? What industry should I be looking at in preference to another? And that's when you start sorting things out. So if I want to buy a bank, fine, but you should have a smaller part of your portfolio in there because there are underlying risks. Put more in something a bit safe. More likely, those that are safer would have probably moved up already by now, and maybe only the ones that are a bit more treacherous are the ones that are already playing catch up as of the moment. So understand that. 3, lay out your trading plan. So everything that we talked about earlier, put it down. Write it down first. Especially for you novices, write them down. I want you to be able to have a mental image of your plan so you know exactly what it is. And after you write it down, it's like a contract that you write with yourself, telling yourself that if this breaks out, I will buy. If this breaks down or this gets stopped out, I will sell. And that written down contract is the testament to what you should be doing and what you should be following. Next, execute without too much emotion. Like I told you in the beginning of this webinar, emotion is your #1 enemy. And because of that, you must try to stamp it out as much as you can. I know there's no way you can do that 100% of the time, but try to put it under good control. Because any emotional trader will not last too long, will not make too much money, because all this interference and noise from the exterior will be bothering you left, right, and center. I have yet to see a very successful trader with very, very heavy emotions controlling his hand. Remember, right mind, right action. And so it's all about your mental preparedness, how you come into this environment ready for what you're supposed to do, getting ready to be able to suit up to what you're supposed to be able to trigger when you buy, and how to be able to exit when it's time for you to sell. And remember, I want you to focus on making the right trade and not on this. As the statement says here, don't focus on the money here. Focus on making the right trade. Money will follow. So that simply means if you practice the right discipline and you follow it well, it's very hard for that money-making event not to come in your direction. But if you're looking at the money, it becomes a distraction to your plan. Because, for example, let's say you're buying a stock, your target, for example, your trading plan says, all right, I'm buying a stock at 10 pesos, my target is 13, okay? And now, what happens? The stock goes up to 12.90, 10 centavos short of 13. And now you ask yourself, what do I do? And you come out and say, no, I want 13. And you don't sell your position, even though 99, 98% of that is already right there in front of you. When you have that, go take it. It doesn't have to be too exact because you want that certain amount, 10 centavos more of that cash. It changed what could have happened. And so please focus on making the right trade. Okay? All right. Let's have a little examples in how to carry out what we've had so far. Because here I have 33 different examples of different things: the PSE index, the US dollar, and oil prices. Now let's have a look at the first situation here, and let's try to be able to learn what we looked at today. Here we have the PSEI index. It's climbed up from this 4,000 low that it hit, and now it's been sidewinding for the last almost month and a half now. And here we are with prices trying to be able to touch on the resistance area. You and I know it broke out today. And so the reason that I want to point this out to you is because I wanted you to ask, why is it winding up and not coming back down? And it's broken through the first moving average, and it needs to break through the 50-day, which is this red line that you see above here. And today it did that. Now the question is, what do I do? Now I have a wind up. Now I have a breakout. Now I have my MACD near the zero line, and now there's a potential for me to be able to make money over here. And so when you give that condition, then you have to be able to try to follow it. And your ability to follow that is depending. Were you prepared for that or were you not? Was it in your capacity to wait for it or not? If you thought that this was going down and that was the only way, then I don't think you'd be making money right now. But if you had prepared for an avenue up here, then maybe you probably had bought some stocks in preparation for that, maybe a minor position, and maybe add up when you buy a breakout. Or maybe some issues were breaking out ahead of time, and I think there were in the last couple of days some issues that were moving. So that preparedness would have helped you a lot in there. So hopefully, since this red moving average is broken, let's hope that we can climb higher and aim higher, maybe between 6,000 and 6,200. Let's look at the US dollar. Now, the US dollar has an area pattern here. So now the question is, should I be looking to do something here like buying it? And so if I were to look at the environment I have an area pattern, and now I see prices breaking down from the area pattern. Now I also see prices threatening to break the 200-day moving average. I also see the MACD pointing downwards and going below the zero line and widening. And the RSI is telling me it's not oversold yet. And so all these indications are telling me there's a potential for this to still go down. So why should I even be looking to be able to go into an upside? So in a case like this, my mind would not be ready to buy this. My mind is ready to be able to sell my position here if I've had one. And I should lay out the foundations of what I do, if not sell it already outrightly. Third, let's look at oil prices. So oil prices broke free from a downtrend line sometime towards the beginning of May. It climbed up to the 20-day moving average, climbed up to the 50-day moving average, broke free from that. It's now sitting on the 100-day moving average, and it's now consolidating near that area. How come? Because there is resistance in here. And if this happens to punch out from that moving average, where do you think prices can go to next? Again, with what we've learned with moving average, we will now look at the next moving average up here, and this could be our next target for it. If you're looking for a potential buy here, you could have bought it in this area with this target in mind. And just in case you're wrong, you can use the moving average as your stop to be able to protect it from any losses that you made. Similarly, if you had tried to buy your index today, you can use the low end of the index here as your stop to protect any losses of becoming any wider from any of these declines that you see here. So in the assessment of what we have, I want to show you that In this stock condition, it was neutral except for the breakout today, in which case this would probably turn into a green environment now. Your US dollar is giving me a red or bearish environment. And so here I'm looking to actually liquidate my position, if not stay out of it. In oil prices, still relatively bullish because it's broken through several moving averages. My MACD is still above the zero line, although it's slowing down in momentum. It could just mean that it needs to park a bit while more. And we're no longer in overbought territory with oil, so there is still a slight possibility that this could continue. But just in case we're wrong, we could put a support stop inside here. So what did we just manage to do over here? Whether I looked at a particular index, whether I looked at a particular currency, or whether we scoped a commodity, or any stock that we looked at for the matter, you were able to look and make inference from anything that we spotted. Anything that has a chart now becomes much more rational for me. I can now see an opportunity to buy, an opportunity when to take profit. I know when to be able to gauge my risk, how to get out in case things become a bit more testing to the downside. I understand that trends do change gradually over in time, and I can use trend lines and moving averages to be able to help me. MACD and RSI to help make sense of the momentum conditions inside. So putting all those things together today, we've learned how to be able to justify our ability to buy a stock. So remember, your trading routine says build your entry plan first. Second, make sure you understand where your stock can go. Make sure it's upwardly viable for you. So measuring your upside targets. Establish your sell conditions. And that means if things go wrong, how do I get out? Be prepared and do that before you execute the buy trade, right? Assess your technical risk reward. If you have many choices in stocks, the more viable ones are the ones that shows the less amount of risk with a greater amount of potential reward. And try to make that assessment when you're starting to pick. And as much as possible, don't have too many stock positions in your portfolio because there's just too many things to watch at all one go. 3 to 5 stocks is a good amount for traders to be able to take. And last but not least, please manage your risk. We're only as good as the amount of funds we have in here. If you attempt to be too slippery with your funds and it attempts to be able to wash off your pocket very quickly, you're not going to stay in this game too long, right? Trading is a serious business. As we said in the earlier definition of when we're talking about becoming a super trader, this is all about treating trading as if we're a business. And so lay out the foundations to care for it at one. Don't take that slightly. The greater push you have to make that discipline work, the better this will turn out for you in the long run. So for those of you who managed to be able to last with me in this last 4-week session, hats off to you. I hope that I've managed to be able to impart a lot of the information that we talked about. We did start with technical analysis and how prices are the more important things to look at. We also talked about trends and how you're going to be following them all throughout and understanding there are 3 trends, up, sideways, and down. And we said that sometimes these trends are interrupted by corrections and area patterns, sideways motions in markets, and we will wait for breakout conditions from them. We will use technical indicators to be able to give assessment of momentum and help assess whether the trend or environment is right for the picking or whether we should have an imperfect trade and maybe back off first. And yes, we have to build a trading plan because we have to make sure that we come into the trading environment, our minds are mentally prepared to take what is there and what's on the table and to try to capitalize on those opportunities when we have them and allow our emotions to take a back seat so that we can maximize the fullness of what this can give for many of us traders.